Good morning, everyone. One of our panelists, Craig Robinson, is caught, and he'll get here just as fast as we can. So maybe we can embarrass him or something like that when he walks in the room, and I'll give him a big round of applause or something like that. But welcome. It's so great to see all of you. It's great to be back in the room where it happens. It's such a great opportunity to be present and to be able to interact with everyone in person after being away for so long. And so thank you all, and thank you, of course, to my panelists. As Dr. Chen had mentioned, my name is Brian Ward. I'm with Trimont, and my guests are, Andrea, why don't you go first?
Sure. Andrea OLSHAN. I started as CEO and president of Seritage Growth Properties. For those of you who don't know what Seritage is, it's the legacy real estate that was Sears and Kmart that was spun off around 6 years ago. So it's a national portfolio, and we are repositioning those assets around the country.
Jim?
My name is Jim Simmons. I'm the CEO, managing partner of Asland Capital Partners. We are a private equity owner-operator based here in New York City. Our core competency is value-add multifamily throughout the U.S.
Thanks, Jim. And since Craig probably won't have a chance to introduce himself, Craig just recently joined Industrious. Prior to that, he was a senior executive with WeWork. And then Craig and I were colleagues several years ago and have been involved really in the industry as friends and coworkers for a long time, and also very involved at HBS. And so he'll hopefully be dashing up here momentarily. So again, welcome. This morning's panel is addressing post-pandemic investment strategies. Just, I guess, some opening observations. I believe that history will significantly judge this time. I do believe that this time is a catalyst for potentially significant change to come, some of which will not become clear for a while. And so here we sit, trying to emerge from this last 2 years and looking for new opportunities in the face of yet what I believe are also still some significant challenges. To give you examples, as we look at the labor markets, we have significantly strong recovery in both the high-wage and middle-wage sectors of the economy, whereas low-wage sectors continue to stagnate. And I think a lot of people were looking for that component of the labor force to be back in action, but so far not yet. And despite that, obviously we're beginning to see really positive signs on the retail side. This morning, both Home Depot and Walmart announced earnings, and those earnings were strong, and it looks like consumer sentiment, at least going into the U.S. holiday season, remains positive. Still tons of capital, probably chasing too few assets. And so real estate and really most asset classes today are priced to near perfection. So we have this interesting dynamic going on. And as we look to emerge from this, I'm hoping that the panel can give us some insights as to where we go. And so I want to break down the discussion today really into two main buckets. One would be the owners and investors of real estate, and the second would be the occupiers, the consumers of real estate. And let's begin with the owner-investor side. And maybe, Andrea, let's start with you. And it seems to have been mostly about multifamily and industrial lately, to the discredit of retail and hospitality and maybe even office. Is that trend continue? Is that a prudent trend, or what are your thoughts there?
Yeah, no, I think that we certainly are seeing an incredibly robust market for multifamily and for industrial all across the country. And where we're struggling is with construction costs. And as construction costs continue to climb, and there's a lot of built-in uncertainty into those numbers, so I think our contingencies have contingencies when we're getting numbers back. We're finding that, sub $2 rents, it's very hard to make deals pencil. I think that's why there's a push to lower density housing. where actually the construction costs are lower. And so where you would always push from an entitlement perspective to density, where now you're seeing the build for rent, single family homes for rent, because you can make the return equation work. But those, like you said, are priced to perfection. We're seeing, 100 basis point spread to development costs. That's really thin. It's dangerously thin. Retail, we're seeing really a tale of two cities. They're the absolute best assets. So we have, there he is.
You were saying something brilliant, and I totally interrupted you.
No, it's all good. No, we were saying how retail is a tale of two cities. So you have the Aventuras of the world in Miami, and you have the University Town Center in La Jolla, where our pace of leasing is incredibly robust, but rents are over $100 a foot. Mm-hmm. You have everything else where you're in, low double-digit rents. But to white box a space from a cold dark shell, you're looking at over $100. So you have 10-year paybacks, 8-year paybacks, and very few credit tenants that you're willing to take that sort of bet on. That's a very hard pill to swallow, and I think that's really what is driving the lack of retail development, which is probably good. We've been over-retailed for a very long time. But I think that a lot of the retailers are not looking for as many locations, so we might just be okay. I think that's why retail has really structural issues that it's facing.
Okay. We're just opening with the owner-investor, or part of on the notion of construction cost pressure, cost overrun pressure. Is it a long-term trend or one that gets resolved in the near term?
I hope that it's a shorter-term issue. Listen, inflation. We are in a positive inflationary environment. There's no question. Except if you look at the numbers for service inflation, the price of services, that does not show as much inflationary pressure as goods do. But we were in such a consumer environment, right? For 2 years, people couldn't consume services; they could only consume goods. But it's going to be factors. It was the summer labor was impossible. Now steel is impossible. So I think it's really, you're going to see upward pressure. I don't think it's going to be the mania that you have right now.
Okay. Jim, any thoughts?
Yeah, I think you have two areas of concern. The first is labor shortages. And as I tell my kids, the people who actually work for a living, which I don't, like the people who are on the cranes and who are out in the cold today actually constructing stuff, those markets are really tight. And whenever you're in a supply and demand dynamic, that obviously drives up the pricing of that labor. Secondarily is the supply chain of materials like steel, like wood, like concrete. And we're in the process of coming out of the ground on a construction job in Washington, D.C., that we started demo back in February, March. So our entire planning process is about how do we not have shortages of materials on site, steel, rebar, I-beams, and ensuring that we are providing enough lead time such that we don't have stoppages because we have a delivery date. So that takes a tremendous amount of planning, and we're competing against all the other construction which is happening, which there's a lot of, right? All you have to do is look up and see the cranes in almost every major city across the U.S. So our concerns are for future development, how can we plan appropriately the cost escalation that we expect to happen both on the labor side and on the supply side as our supply chain continues to be disrupted, primarily because of COVID.
So again, do you see, for example, labor pressures as transitory or sustaining?
I believe that the labor shortages will be transitory, but the price increases will be sustaining. So I don't think that you can raise salaries and then retract them in the future.
Very difficult.
Right? It's gonna,
Yeah.
wherever we end up, that's where we're gonna end up. So I think you'll have enough individuals and bodies to get things built, but I think the cost structure will be embedded.
Yeah. Craig, thoughts?
Well, one of the ways in which I think about mitigating some of these pressures is just by moving away from thinking about the process as a service and more of a kind of productizing, space. And so obviously I'm with Industrious, and one of the ways in which I think about mitigating some of the kind of pressures around costs is like having a really, really tightly designed, well-engineered, very efficient product, right? Doing so with as little labor contributions as possible, making it more, repetitive and formulaic, so that over time, on the margin, every margin matters in terms of pulling out costs and that type of thing. But by and large, you guys are thinking about how do you allocate capital and thinking about that more broadly. I'm thinking about it down at the product level, opening, literally products across the country, across the world, when you're dealing with, labor, construction, all of that. And one of the ways I think to kind of hedge that is just really thinking about it as a product and being tightly designed and controlled from that perspective.
Okay. So I want to stay on this topic of asset class a little bit. I led Andrea with you in this notion of multifamily and industrial. I want to explore whether there are opportunities or whether herd mentality in multifamily and industrial, and you don't have to agree with that, that presumption, by the way, whether that's going to create post-pandemic opportunity in the seams for things like hospitality and retail and office. And of course, I'm sure there's nuance to that answer, which is yes, but I think it would be meaningful for the audience to hear your thoughts about those asset classes from the owner-investor perspective, and post-pandemic, where the opportunities lie there or where the challenges lie there. And why don't Craig, you want to take a whack at it and we'll work our way back?
One, I think there's some interesting asset classes that did not make sense, years ago that now make sense. Like, for example, SFRs. There's a ton of, single-family rentals, a ton of interest, I think, in that space. It's a $4 trillion category, 98% of which is kind of owned by mom and pops. And heretofore, it wasn't a very efficient asset class to kind of get after. And I think what's interesting to me is like how technology and innovation is allowing us to kind of go find yield in other places that we haven't found before. So there's $40 billion of institutional capital that's moving into that space. To me, I think that's really interesting. I'm on the board of Roofstock, and their platforms will allow that to happen more efficiently. I think the other way in which I think about asset classes is the repurposing of them for, emerging uses and personas. For example, you were talking about retail. We are now opening up locations in, co-working, units inside of retail, right? So repurposing, rethinking where can work be done. Maybe the higher and better use for retail is fulfillment. But in many cases, I just visited one of our locations in California. That is a place where work can be done. So also thinking about how we can, repurpose assets to find additional yield. And then certainly on the office side, I think about different use cases now making sense. Like, it did not make sense to have small businesses and freelancers and gig workers, but now with technology and certain platforms, owners can now trace additional yield where there's a premium that is willing to be paid by certain kind of tenant classes that could not access the supply, and the supply could not access that demand. So I do think, to summary point, innovation technology is allowing us to find yield in historic asset classes that we know really well, but with different use cases, and then also repurposing assets to do things that we haven't done. And then lastly, thinking about things like SFR, which I think there's a massive amount of opportunity if you have the right platforms to kind of go after it.
Real estate is historically a very late adopter when it comes to technology, right, and its influences on investment decision and the like. But I'd like to kind of also delve more into that if we have time and get your guys' thoughts about where you think post-pandemic technology is really going to start to move the needle materially. And certainly SFR is one that strikes me as being a good bet.
Yep.
So, Jim?
Yeah, I think that the winners are the people who think outside of the box, and for those of us who are in the later generations to listen to those people, because I don't think that I'll speak for myself, I don't think that I have the best ideas. So as we look to build or to add value to our multifamily assets, you try to think about what your tenancy is actually going to want on a go-forward basis, and not tomorrow, but 5 years from now and 10 years from now. And to what Craig was saying, we're thinking about, okay, we're transitioning to a real-time delivery system where if you see something online, how quickly can it get to you? And if you talk to the Amazons of the world, that's what their entire business model is about. How quickly can they get goods and services to you? So what that means is that storing those goods and services either in a semi-permanent or intermediate fashion, which is closer to you, is going to be in higher demand. So as we have potentially excess square footage on our assets, can we provide that service? So can we provide a space where an Amazon can say, here are the top 30 things that people order from your building that we're going to hold in stock? And can we partner such that we are solving that fulfillment problem for them, as opposed to them building warehouses and figuring out how to get a drone from the warehouse to my building? So thinking about things like that, including technology and how that works, are things that we're looking at from a multifamily owner perspective. From a retail perspective, because I happen to have some affiliations there, it's how can you maximize what today may be underutilized space, and what does that look like? And do we partner with an Industrious to say, you're bringing the workplace closer to the individual, as opposed to have the individual move closer to the workplace? Those,
answer is yes.
right. So having those types of conversations, those partnerships with individuals, firms that are at the forefront of their world and solving their problems is sort of where we want to be.
I mean, I'll tell you guys that I was a skeptic at first that this period of time would have long-term sustaining impacts, generational impacts on how we consume, invest, occupy real estate. I'm now in the opposite camp. I think that we are on the precipice of long-term generational change in terms of what goes on. I believe in the great accelerator comment that's thrown about. Generally, I think it's more complex, but I think that we are embarking on a period of time now that will really shape it, like I said, for our grandchildren. Andrea, I want to come to you because your task at Seritage strikes me as being massively influential in that quest. As we look at taking one of the largest big box retailers, occupiers of real estate, influential not only in the industry but on communities, how we use real estate, and where that massive square footage goes next. And so I'd love to get some of your thoughts there.
Sure. Listen, that's why I took the job. I mean, I think it's the most interesting thing, with all due respect to everyone here in the industry, that's happening in the industry, right? A lot of people have ideas. We have properties, and that is the scarcest resource right now, right? You can't get deals. The deals are priced to perfection. We have 170 assets that we're repositioning. Our vacancy is our opportunity. So I walked into only 40 assets being 80% plus leased. Everything else, blank slate. A third of that portfolio is going to be multifamily, low density multifamily in secondary and tertiary markets. Tremendous opportunity. Another swath of that, not as much as I would like, is going to be some form of office, life sciences, or logistics. I think logistics is a tremendous opportunity that is not being built, not because it isn't justified by the communities, Because if you think about the logic of a shopping center, right? Access to highways, access to populations, large parking lots, easy in, easy out, right? You think about all those factors that made a mall a good location. Same thing for some sort of last mile. The problem is the municipalities don't want it. And there is a disconnect between what is warranted and what is permitted. And that's something that I think will hinder the repurposing of a lot of these boxes. We have probably 20 assets that should be multifamily. The rents are there, the demand is there, the people want it, the towns don't, the cities don't.
Is it because of traffic, or is it because they think it's going to negatively impact their communities?
There's a lot of reasons, and I think that, I mean, it could be so far as they think that, you know, it's a large conservative stronghold, and they think that people who are renting are more democratic. It could be traffic, it could be pressure on schools, and I think that's where if cities were smart, instead of just saying no, they would say, okay, low density makes sense. Right? Like, how do we create a low density environment? How do we loop in retail? They're very afraid of losing the tax basis that comes from retail, but the mall is already dead. So it's gone. So are there ways that you can create out parcels or, you know, small nodes of shopping, but with a larger residential component? Make it age restricted. Right? If you're worried about school capacity, make it age restricted. They're not thinking about these ways just yet. It's also hyper localized. And when you think about, you have really well-meaning people that are not trained planners, not trained architects, not developers, making really critical decisions about our cities all over the country. And there needs to be some sort of top-down perspective given. But I think that said, the opportunity set is still massive. And it's really interesting because it's a bespoke solution for every property. You can't just say, well, we're gonna make every single one last mile, we're gonna make every single one multifamily. It really has to meet the market. You asked a question before about from an investment perspective, and this is interesting. So we have 40 assets that are well-leased credit tenants, not as much grocer as I would like, but it's a lot of value players, so credit value, so Burlington, BJ's, you know, Floor and Decor, At Home, Ross, all those sorts of guys. When you talk to the brokers, they've never sold those assets or looked to finance those assets that are attached to the mall but don't speak to the mall. So that's like an untested market, which is interesting. People don't know how to finance it. It's funny, I was with Brookfield and they said, have you guys done any like asset level financing? So I was like, you're asking me? They said, well, now we own all these JCPenney boxes. We haven't tried to do it independently. So and I think when we show that there's real traction for that, I think then independent people can buy the one-offs, right? Because JCP is more splintered, Macy's is selling boxes one-off, Lord & Taylor is doing a mixed bag of things. I think that'll be interesting. The other opportunity is that most of our assets that are leased are value retailers. So but there is a herd mentality. It's grocer, 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 grocer. You speak to any institutional investor, any pension fund, all they want are grocery. I said, well, look at the credit profile of some of the grocers you're buying in these portfolios and the average lease term. I have an over 8-year average lease term, and my credit profile is very high. Is it interesting to you at a 100 bip spread to grocery anchored? Is it interesting to you 100 bips? I was like, yeah, I mean, think about it. It's a very, that has to be the next level, right? Where if you can really get 150, 100, even 75 basis points of spread in terms of buying those value retailers, there has to be some movement there. I think that is an opportunity.
I mean, it's just interesting because, if you buy into my thesis that we are on a generational change path right now, I mean, strikes me as such an incredible opportunity to change neighborhoods, to change communities, to affect issues around affordable housing, to create more of an opportunity for people to have options instead of going in the traditional, urban environment to work, to be able to create live-work environments or just multi-purpose types of areas that meet the needs of people in our communities. Then you throw in the complexities of resistance to change for sometimes no particular good reason other than you don't want change, that the complexities of the political world, the government world, whether it be at this local, state, federal level, really add a concerning mix.
I think you're spot on. To me, this is a structural change in kind of human behavior. I mean, we talk about tenants as this kind of like abstract entity, black box, but they're a collection of human beings with human preferences. And if you were a retailer 10 years ago and you were discounting the impact of omnichannel and this, that, and the other, and just realized how quickly human preferences change fundamentally the way we think about that asset class, and you're experiencing it firsthand. And I think we're missing, to your point, that this is happening at scale across many asset classes. The same person who's renting a 2-bedroom, 2-bath in your apartment is the same person who's working in a flex space, who's the same person who's, instead of going into a restaurant, now going on Grubhub and now consuming content and this, that, and the other differently. And if cities and supply aren't more malleable and responsive almost immediately to these changing preferences, they're going to miss a big, big opportunity. I think it's existential, to be honest. And they're not going to wait for companies to tell them or institutions to tell them how to behave and where to go live. They're making these decisions, and they're empowered to do so very quickly. And unless our businesses are more dynamic and more responsive and in tune to these changing, and I think, to your point, structural, like I don't think this is coming back. I think it's forever changing, and there's probably kind of a network effect here. Then I think you're going to have a lot of losers, but those who get it, I think, whether it's a city or a business or an owner, being very in tune with these changes, I think there's a lot of opportunity there.
I agree 100%. Yeah. It's going to be very fun, Andrea, to watch the evolution of your business and how it really affects communities going forward.
No, there's no question. I mean, the thing that we don't talk about is that, and I mean this with tremendous love, but you guys don't pay rent. So I think there's a lot of the innovation that you want to do, you can't afford to do, right? I think there's a bit of a disconnect. And so you look at people deciding to go with a Burlington deal, right? Or an at-home deal, which is obviously not as exciting as Industrious. It doesn't provide the service that an Industrious does. But to build out an Industrious and to have a management deal, right, where you're getting paid a percentage, it's unfinanceable, right? And it's, if you're well capitalized, maybe you'll do it and you'll say, okay, I could build multi off this, I can lease off this, I could do things off this. But it doesn't pencil. So how do you, we have to figure out a way in which the users of the future actually make it economically feasible for landlords to create space for them.
So, I mean, listen, I think there are a number of different ways in which owners can think about chasing the long and I think, growing tail. I mean, if you talk about kind of the demand for flex, it's probably 2 to 3% of the market. We think that's going to be at 15, 20%. There's no way you can not have a strategy for how to capture and take advantage of it. One, people are going to expect it. Two, it has spillover effects to the rest of the asset. And I think we're now seeing that there are very capital efficient, very smart ways, which is kind of how I opened, for how do you kind of go after that in a very thoughtful way. But the reality is, we have a point of view that the partnership model is the right way so that you actually can participate in the upside. If you can get 1.5 times the market rent or twice the market rent, that is financeable. And if you can demonstrate that ability to aggregate demand the way you could a hotel or any other thing, I think that is something very much. We underwrite deals the same way you would in terms of looking at IRR and that type of stuff. So I think the reality is this industry is evolving. It's getting smarter in terms of like what are the must-haves in the space that you really need to spend CapEx, and you should, and what are the returns that you should expect on that. I think the desire to have exposure to that additional alpha it's what is driving a lot of people to say, this makes sense. Now the question is, who's the right partner to do that? Who has the ability to consistently drive demand? And how does that benefit the rest of my asset, whether it's an office asset or the retail, or people are now going to go and work and then go shop and then go buy food and this, that, and the other. How do I capture and think about all of that value? But what is undeniable is that the demand side not only expects it, but is going to only go largely, and I think over time, where those options are there.
Jim?
That's why I'm a multi. So I have to have this fight about credit and future alpha. Look, I think I want to follow up on a point that you made, which is I think it's incumbent upon municipalities and governments to make that sort of trade economic, right? Which is say, okay, if we don't think the highest and best use is another Burlington or the like, which is the most economic and highest and best use for you, and we think that co-working or multi or affordable housing is a better use, then we should do what we can or what we have to do to make it worth your while. And that's either change zoning to give you additional FAR or give you tax abatements or the like, because what's there today, which is a dark mall, is not tenable. And you can't view the world in an immediate today. You have to view the world in 5, 10, and 20-year increments. And what I find that the best governments do is they actually are thoughtful about what the world should look like 5 and 10 and 15 years from now, and not take a stance that we don't want to change for the lack of changes, for the reasons of not changing. And I think that cities have gotten some things right in trying to compete with suburbs, but there are extra steps that need to be taken to make it more economically viable for people like us to do what we do and provide the goods and services and places to live and work that their residents deserve.
So I got to ask, kind of pivoting again, going back to the occupier demand side of the equation. And you talk about city governments and their abilities to sort of change with the times here. Can they? Can cities really evolve here to meet the changes in demand, the expectations that the consumer has for real estate, or are urban environments going to struggle for the next 5 or 10 years in terms of how they figure out to reposition their value proposition, to the marketplace? Do you see what I'm getting at here? I'm trying to understand, I'm trying to ask the question in a different way than everybody asks it, which is everybody coming back into the urban environments, or are they going to start saying, you know what, I'm fundamentally altering how I conduct my day going forward, and instead of going into an urban office environment, I'm going to go out to a repurposed Sears retail area where I can live and work and conduct my life and not have 2 hours of time on the road?
I think there are some that have gotten it tremendously right. I mean, if you look at what's happening in Nashville today.
Okay.
Nashville's attracting young people, they're attracting businesses, they're attracting real estate investment capital. They've leaned into that which they saw an opening in the entertainment side of the business. They've also leaned into hospitality, eds and meds. There's probably not a sector in which they have not found an opportunity to be the best in their region, and in many instances, the best in the United States. I mean, I wasn't aware until I went there recently. It is the bridal shower capital of the world, other than Vegas. I mean, that is a true statement, which I had no idea. But they leaned in heavily to that and said, we are going to make that our business. And so cities who establish a long-term plan and say, here's where we want to be, and here's how we're going to get there, and we're going to work collectively, the entire business community, the entire political community, if we come together, then we can attract capital, we can attract people to move there. I think that as we look at our great city here, we need to have that sort of a thought process as what are we really good at? What do we want to be? Not today, but 5 years from now, 10 years from now. What are the policies we have to put in place to get there? And by the way, what are the policies that are in place today that are impeding that growth?
Yeah, you know, I lived in New York for 12 years, as you know, and only a few months ago moved to Atlanta. Largely quality of life, cost of living, that type of stuff. It used to be that New York and other kind of major cities kind of had a captive, you know, kind of control on talent, because that's where the jobs were, and that's where and so this is kind of flywheel. And I think what the last 18 months have showed us is that now cities have to compete for population just the way companies have to compete. And some of the guardrails, some of the constraints around mobility of people, of talent, are now gone. And so the same way, you know, office landlords are saying, how do I get people to come back into these spaces, or the same ways in which cities are saying, how do I get people to like come back into the city, I think there has to be a value proposition. And the value proposition, at least from, you know, kind of where I sit, is, you know, experience. Like, let's just say in the office, the single reason why people will go back into the office is not because that's where they can get work done. We actually saw that productivity was quite high, if not higher, when people worked remotely, particularly if there was trust and they had been employees of the company, blah, 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 blah. But by and large, there has to be a value proposition for why people come back, and that's experience, it's collaboration, it's engagement, it's connective, it's belonging, and it's all of these things that we've never really kind of quantified. And at the city level, the same thing. It's affordability, it's the belonging, connection, community, that kind of stuff, optionality. But I think in order for, at least on the real estate side, for us to think about wrapping our mind around, you know, this kind of very kind of fluid and hard to kind of quantify thing, it's just how do you create an ecosystem of options for where people can live, where they can work, the types of work they can do, when and where and how they want to do. We did a survey of over 20,000 of our members, and they said on average they will probably come back into the office 3 to 4 times a week. Right now they're probably doing that 1 to 2 times a week. And that over 70% of them said that they will make the decision which days they come into the office. So they're empowered to now think about where I want to work, where I want to live, and is there a value proposition that's compelling? And it's no longer that I have to be in the office to be seen, to be managed, to get promoted. I have to live in New York to get a good job. And so, you know, as we think about kind of return to work, return to normal, which I don't think that exists, you know, I think we spend a lot of time thinking about what is that value proposition and how do you do that at scale, in a way that's not forced, but really there's the kind of the pull versus the push.
Okay.
I think it's great. I mean, I think this is the best thing to happen to secondary and tertiary cities all over the country.
Yep.
Right? It really is, because there was such a gravitational pull, and there was such a talent drain. And people other than professionals didn't ever go home. Right? Like you ask a lot of people are like, oh, you're from New York? Yes. Like it's an unusual thing in New York because so many non-New Yorkers moved here, and they moved from all over the country, and they would never go back. And now the fact that they're going back is the greatest thing to happen to those cities. And I think you know, there's competition, and I think it's competition for, like you said, quality of housing. I mean, if you have children that are school age, there are not that many cities you can go to where there are really good schools and good options. So there's more competition for that. Taxes, you know, being pro-business. I think it makes everyone, competition's good, in making, you know, cities up their games, not just, you know, private landlords.
So we're almost at time. Oh, sorry, go ahead, Jim.
I also think that what COVID did was it allowed people the opportunity to go back home, right? So those 20-somethings and 30-somethings who went back home for some period of time, and then they realized, you know, this is not so bad. I still believe New York City is the center of the universe, but I also enjoy going for a hike in the Appalachian Mountains, right? I remember doing that as a kid. So I don't think that cities like New York, LA, Chicago, Boston, that they are going to be bereft of talent. But I also think that there's going to be a higher percentage of people who don't need to do what you said, which is be in New York City for the rest of their lives.
And just one other quick thing. I was talking to a number of tech tenants who've been hiring hundreds of employees per month, if not more, who've never ever stepped foot in an office. Like, the fact that people have been hiring folks who have never been in the city, have never been in the physical space, is in many ways also signaling that that's no longer a limiting factor. And at some point they'll have to go somewhere, but the question is where and what will be the value proposition.
I'm not convinced that's long-term healthy, but that's a whole nother panel.
I may agree with you.
I'm going to call, because we're at time, I just want to exercise like a moderator's audible here really quickly. Inside the context of post-pandemic investment strategies, really quickly, are there things that we can do to advance diversity, equity, and inclusion better? And thinking about the context of owners, investors, and occupiers, are there things that continue to advance that pace of change?
Go first.
Yes. Unfortunately, the watermark is so low that I don't even have to tell you how to split an atom for you to really like have me. I mean, like, one, people care about the S and ESG, you know, and employees want to know that they're working for a company that represents and reflects their values. And that is as important as everything else we've just talked about, you know, kind of tenant behavior. You know, if you've got a huge population in Texas, what's your stand on voter suppression? So it's not just inside the four walls of how do we create a more inclusive environment, how do we attract and retain diverse talent, how do we promote and have more mobility, but it's also to what are we doing as it relates to those topics outside the four walls, throughout our supply chain, or our capital strategy, our PAC dollars. And I know that's a whole lot, but I think the burdens on companies to do more than just think about diversity and inclusion in the way we did for the past 20 years and think about it more broadly, I think is something that we should be thinking about and almost have to think about.
Andrea?
That's interesting. In certain ways, I think about it being less political, if you will. I think you have to think very locally. I think there's actually a lot more diversity on the local level than there is in some of the large conglomerates, and I think you have to really prioritize it. I think unless you look at every single contractor you have, every consultant you have, and really make it a focus and measure it. I agree with you. The bar is so low, and you have to really try. And I think a lot of people, if you actually read the slides that are on their website or in their presentations, they're very, very light. And I think you really have to make it. If you're going to do it, then it's every single bid has to have, a minority or women-owned business. Every single bid for every single thing that you do.
So we're at time, but look, I asked the question on purpose because I think that if you buy my premise that we are on a precipice of generational change, I think we have to constantly ask the question as a part of everything that we do, whether it be deploying capital, occupying real estate, thinking about the implications for environmental, social governance, and also DEI as a component of the DNA of what we're doing in every single thing. So
Just have one comment.
yeah, Jim.
I agree with Andrea that I view it very simply. There are two things that I can do daily to make a change. And if you view it like NYU, I went to Princeton, I go a little bit of an extra mile if there's a Princeton alum. I'm sure NYU alums do the same thing. You can go that little bit of extra mile to have a person of color or a woman interview for a role, or tell the headhunter, I'd like to see more people from underrepresented groups. And if you have that conversation, that at least puts it in their mind's eye, and it at least opens the possibility that someone will get hired who wouldn't ordinarily.
Thank you guys for indulging that question. I think it's really an important one as we finish here. Again, thank you to NYU. It's so great to be in the room with all of you and appreciate you guys attending this conversation. So sorry we didn't have time for questions. I've run over, but do try to grab us afterwards if there's anything we can answer. Thank you.